Most people think $1,000 isn't enough to change your life. In 2026, they're wrong. If you just throw this into a random hot tech stock or leave it in a checking account, you're losing to inflation and market shifts. But this exact split? It beats most new investors because it's designed for the actual economy we're living in right now, not the one from 5 years ago. Today, I'm giving you the 2026 beginner roadmap. We're moving past the Magnificent Seven obsession and looking at where the real money is moving. AI infrastructure, high-yield locking, and the halo sectors. By the end of this video, you won't just have a plan. You'll have the exact ticker symbols and the step-by-step breakdown of how to execute this. All right, let's get your first 1,000 working the right way. Simple rules, clear execution. Stick with me for a few minutes and leave with a portfolio you can actually run. Welcome to InvesYou. If we're serious about building a portfolio that actually grows while we sleep, hit that subscribe button and join our community. We track these trends weekly, so we don't have to. Now, let's be real. It's 2026. The world looks different. We've seen the AI hype cycle settle, interest rates are stabilizing, and the easy money era is over. If we have $1,000 sitting in our hand, we have a massive opportunity. But before we buy a single share, we have to talk about the foundation. Foundation, platform, core split, automation, and accountability. This is the difference between guessing and growing, and we keep fees and friction out of the way. All right, phase 1. We build from the base up. Simple steps, solid outcomes. Let's lock this in. Visualize a pyramid. The base is our emergency fund and any high-interest debt. I know, we want to buy the next 10x stock. But if we have credit card debt at 22% interest, any investment we make is technically a loss. Paying that down is a guaranteed return that beats most markets. Step 1, the debt audit. If we have high-interest debt, that 1,000 belongs there. List balances, APRs, minimums. Target the highest APR first. That is a guaranteed 20% plus return on our money. Step 2, the HISA strategy. In 2026, cash is not a strategy, but cash is a tool. We're seeing high-interest savings accounts offering around 3 to 4% sustainably. I remember when I first started, I put my last 500 into a stock that tanked, and then my car broke down. I had to sell at a loss. Don't be me. A small safety net stops forced selling. Action item. Ensure we have at least 1 month of expenses in a HISA before moving on. This is our green light. Pause later. Do a 15-minute audit. Balances, due dates, auto pay. Set a small automatic transfer to the HISA while we plan the portfolio. Then we invest with less stress. Foundation done right makes every other decision easier. Now we pick where we invest, without fees eating us alive. Low friction, high control. Phase 2, selecting our platform. Clean interface, instant funding, fractional shares. Let's compare the essentials. Fees, fractional shares, and tax-advantaged accounts. We want every advantage on our side. Keep it simple, keep it efficient. Onto the platform. In 2026, fees are the enemy. If our broker is charging us $10 a trade, that's 1% of 1,000 gone instantly. We don't donate returns. Look for zero commission trading and tight spreads. Learn to use limit orders to control entry. Fractional shares, non-negotiable for a $1,000 portfolio. It lets us buy $10 worth of a $500 stock. Account types. We focus on tax-advantaged accounts. TFSA in Canada, Roth IRA in the US. Why? Because in 10 years, when that grows, we want to keep every penny of the profit. Checklist. Zero commission, fractional shares, tax-advantaged, auto-deposit, and clean UI. Add two-factor authentication and insured accounts. If we have that, we're set. Now the fun part, building the core portfolio. "60% World Engine, 20% infrastructure, 10% yield lock, 10% wildcard." We'll start with the World Engine. Own the economy, not just a name. Let's build for resilience. Segment A. Let's go. Broad exposure, simple upkeep. ETFs first. Clarity over complexity, here's how. We buy the market. We aren't picking winners, we're owning the economy. Ticker recommendation: VTI, Vanguard Total Stock Market, or VOO, the S&P 500. The 2026 twist. Why still do this? Survivors rise in, laggards fall out. While individual companies fail, the top companies are designed to be the survivors. From our $1,600 goes here. Either pick one fund for simplicity or split. Both are fine. Turn on fractional and set auto invest monthly. Expect ups and downs. The trend is what we care about. We don't chase headlines. We own the engine and let it work. Cycles come and go. Broad exposure compounds. Segment B, infrastructure. In 2026, everyone has AI software, but everyone needs AI power. Concept: the halo trade, heavy asset, low obsolescence. Focus: utilities and energy, electricity for data centers. Ticker recommendation: XLU or specialized infrastructure ETFs. This is growth with a floor. 20%, $200. Lock the yield, then we play our wild card. Software is flashy, but power is fundamental. Compute runs on electrons. We want assets with regulated cash flows and durable demand. Utilities, transmission, and energy infrastructure. XLU gives broad utilities exposure. Allocate 200 here. Fractional, limit order near mid. Prefer a broader approach? A diversified infrastructure ETF can work too. Be aware of rate sensitivity, but demand is sticky. Heavy asset, low obsolescence. Halo gives us stability feeding AI's growth. Cash flow, dividends, essential services. Segment C, yield lock. For the first time in years, bonds are cool again. Strategy: lock 4 to 5% yields while rates sit near neutral. Place 100 into a high-quality bond or short intermediate bond ETF. It cushions if the market has a hiccup in late 2026. Segment D, the wild card. This is for conviction and learning. Maybe a specific stock like Mercado Libre for fintech growth, or a bit of Bitcoin as digital gold. Keep it to 10%. That's the rule. With yields normalized, this is where we lock a floor under our portfolio. Quality first, check duration and fees. One order, then leave it. It smooths the ride. This is the money we're allowed to be wrong about. Research, thesis, small position. Win or learn. Whether it's merely a niche AI supplier or a bit of BTC, cap it. The engine still dominates. Recap. 600 to the world engine, 200 to infrastructure, 100 to yield lock, 100 to wildcard. Queue the orders with limits where possible. Now we automate. Monthly contributions beat market timing. If we can add 50 a month to this start, watch what happens. Compound interest does the heavy lifting. In 2026, our brain is our worst enemy. Automation is our best friend. Set and forget the funding. Next, how we maintain without overthinking. Systems over impulses. The biggest mistake beginners make is investing the 1,000 and never looking at it again, or worse, looking every 5 minutes. We want a cadence, monthly contributions, quarterly reviews, calendar it. If it's scheduled, it happens. Dollar cost averaging smooths entry and emotions. If we can add just 50 a month to this start, look at this curve. Most of the magic is time in market, not timing. Automation removes willpower from the equation. Small, steady buys add up. Control inputs, weekly summary, not hourly noise. Set a drift alert. If allocations move 5%, we consider rebalancing. Rebalance on schedule or on threshold, keep costs low. Rule of thumb, quarterly glance, annual rebalance. Consistency beats intensity. We've built a system that grows while we live our lives. Closing summary and your action step next. Small decisions, big trajectory. Let's wrap. Investing $1,000 in 2026 isn't about getting rich tomorrow. It's about not being in the same financial position in 2027. We covered clearing high-interest debt, using a no-fee fractional share broker, the 60-20-10-10 split, automating our future. If this roadmap gave us clarity, drop a comment. I'm starting. Grab the free portfolio tracker template in the description. I'm your name from InvesYou. Build your wealth, stay consistent, and I'll see you in the next video.